Hello, everybody. How are you? I hope you are well, you are safe. Before I begin, let me introduce myself first. My name is Sarlian Spoma. You can call me Charles. I am a student of Sekolah Tinggi Ilmu Ekonomi, Indonesian European University, Surabaya. So now, I would like to explain to you about financial management, focusing on financial statements. What is financial statement? Financial statement is an organization collection of data according to logical and consistent accounting procedures. Its purpose is to convey business activities or understanding of financial aspects of a business firm and financial performance of the company. It may show a position at a moment of time as in the case of a balance sheet or may reveal a service of activities over a given period of time, as in the case of an income statement. Finance statements are also used to ensure the accuracy and for tax financing or investing purposes. So financial statements include 1. Balance sheet, 2. Income statement, 3. Cash flow statement, and 4. Supplementary notes. Okay, what is balance sheet? Balance sheet, which shows the entity's assets, liabilities, and stockholders' equity as of the report date. It doesn't show information that covers a span of time. Balance sheet is also called as position statement, which reflects the financial position of the firm at the end of the financial year. Second, income statement. Income statement shows the results of the entity's operations and financial activities for the reporting period. This is how it differs from a balance sheet. It includes revenues, expenses, gains, and losses. Income statement helps to ascertain the gross profit and net profit of the concern. Third, cash flow statement. Cash flow statement shows changes in the entity's cash flows during the reporting period. Fourth, supplementary notes. Supplementary notes includes explanations of various activities, additional detail on some accounts and other items as mandated by the applicable accounting framework such as GAAP or IFRS. The full set of financial statements is expected when a business is reporting results for a full financial year or when a publicly held business is reporting the results of its fiscal quarters. Now, we go to understanding balance sheets. Balance sheet provides an overview of the company's assets, liabilities, and stockholders' equity as a snapshot in time. The date at the top of the balance sheet tells us when the snapshot was taken, which is generally the end of the fiscal year. So, guys, the balance sheet formula. It is assets is equal liabilities plus owner's equity. Business assets. Business assets are items or resources of value such as property, inventory, trademark, or patents that your business owns. Business owners can convert assets to cash. Many business assets generate the revenue and benefit the owner in the long run. Different types of assets in accounting. So we can classify assets as 1. Tangible, 2. Intangible, 3. Current, and 4. Fixed. What is tangible assets? Tangible assets are physical items that add value to the company. Some examples of tangible assets include cash, equipment, land, inventory, bonds, and stocks. Tangible assets depreciate over time. When you depreciate an asset, you spread its cost over a certain number of years. Tangible assets can also be broken down further into two categories, current and fixed assets. Intangible assets. Intangible assets are the opposite of tangible assets, non-physical items that add value to the business or intangible assets. Unlike tangible assets, you cannot easily convert intangible assets into cash. You can amortize intangible assets. The amortization of assets is when you distribute the cost of intangible assets over time. It can be difficult to determine the cost of intangible assets because there are not physical properties or items. Intangible assets include things like logos, patterns, trademarks, copyright, customer list, and business licenses. Next, current assets. Current assets are items of value your business plans to use or convert to cash within 1 year. Most businesses use current assets in the day-to-day business operations. Current assets are also considered short-term investment because you can convert or use them within 1 year. Some of your current assets may also be liquid assets. Liquid assets are assets you can quickly turn into cash like stocks. You can convert assets in a short period of time, such as 1 month or 60 days. Types of current assets may include things like cash, accounts receivable, inventory, and prepaid expenses. Fixed assets. A fixed asset or non-current asset is a long-term asset that continually brings value to the business after 1 year. You cannot convert fixed assets into cash within 1 year. As you grow your business, fixed assets have bring long-term value to your company. Because fixed assets are considered long-term assets, they typically depreciate in value over time. For example, the cost of the fixed asset like property is spread out over time only 1 year. Fixed asset can be tangible or intangible. Some examples of fixed assets include cars, lands, building, and machinery. Now we look the next point, equity and owner's equity. The term equity means something of value or worth. It can also mean ownership. Generally, when looking at equity, you want to consider the value of something and how much you owe is on that value. Owner's equity is that ownership in the business is the amount of the business assets owned by the business owner. It is the amount the owner has invested in the business minus any money the owner has taken out of the company. Owner's equity is one of the 3 major sections of a balance sheet. It has several subsections. Invested capital. This is the total investment for all owners, shareholders. Second, retained earnings, beginning. This is the retained earnings at the beginning of the accounting period. Third, retained earnings. This is the retained earnings for the current of the accounting period. These 3 amounts are added together to get the total owner's equity. Types of financial analysis. Analysis of financial statement may be broadly classified into 2 important types on the basis of material use and second, methods of operations. Based on material use, external analysis. External analysis is very much useful to understand the financial and operational position of the business concern. External analysis mainly depends on the published financial statement of the concern. This analysis provides only limited information about the business concern. Second, internal analysis. This analysis is used to understand the operational performance of each and every department and unit of the business concern. Internal analysis helps to take decisions regarding achieving the goals of the business. Second, based on method of operation. First, horizontal analysis. Under the horizontal analysis, financial statements are compared with several years, and based on that, a firm may take decisions. Normally, the current year's figures are compared with the base year. Base year is considered as 100, and how the financial information are changes from 1 year to another. This analysis is also called as dynamic analysis. Second, vertical analysis. Under the vertical analysis, financial statements measure the quantities relationship of the various items in the financial statements on a particular period. It is also called as static analysis because this analysis helps to determine the relationship with various items appeared in the business. For example, a sale is assumed as 100 and other converted into sales figures. So guys, with practice, you will understand better. So thank you. That's all. See you guys.